Hey traders, Raghee here. Let's get a quick audio and video check. I think we're good to go. Changed a couple settings here for charts and coffee. Happy Wednesday, everybody. As we are winding down this month of September. Great to see you all. All right, so taking a look at my notes here. It's still very much a market that's going to be ruled by this calendar. So for those of you that haven't checked out the calendar and looked at what we have slated for Wednesday, we had Powell yesterday, pending home sales, crude oil inventories today. Crude oil has been on a tear. The rising prices in crude have now natural gas has company in terms of a strong energy commodity. And it's bringing, with it, that tide, it's bringing up XLE, OIH, and now they're sort of keeping pace with XOP, which has already been a relative outperformer in terms of the ETFs. And as if we haven't had enough of Powell, we've got this panel discussion, ECB forum, 11:45. Now, this is a whole lot better than the timing for yesterday's CARES Act testimony, because that was right at the clearing range, the end of the clearing range, the top of the hour. And that just really does create a far more problematic caution day. In terms of after Powell, Bostic seems to be batting cleanup today. And, that just takes us into tomorrow's GDP, PMI, Williams, Bostic, Evans. It just doesn't stop this week. And then we get to Friday and we get the PCE, which is the Federal Reserve's pet inflation number. And we have ISM manufacturing PMI numbers. So it just doesn't let up. We've got a lot going on in terms of events this week, kind of creating this caution week. And it's not that our setups don't work on days that have these kind of data points or events scheduled. It's just that the market can be so much more volatile and unpredictable. So the probabilities around, our seasoned patterns and probabilities tend to get rattled a bit because there is a larger, looming event that could just say, I don't care about your moving average. It doesn't matter to me that your indicator is overbought or oversold. This is what came out of Jerome Powell's mouth, or whatever it is. And that's just a way that different catalysts for the markets can sort of eclipse another. And I just want to keep that in mind, that my secret squiggles, as I like to call my very own indicators, just on a day that we have, events scheduled, are simply just not always going to be capable of exactly identifying where support, resistance, overbought, oversold is going to be. All right. So with that being said, let's jump into the questions. Thanks as always for being a part of the Charts and Coffee crew. Let us get into it. All right. Hey there, James. Good morning. Good morning. Looking to enter PLTR. Sure. As it touches the wave, it's there. It's there. Would I enter now or wait for the inside day pattern? Now, with some charts, with some symbols, I can refer back to my beloved historical volatility over at AutoChartist. And, PLTR is just not one of those symbols that they provide data for. And there are situations like that. So then what do we do in a situation where I may not have the historical volatility measuring stick that I have in probably 90% of what I trade and invest in, quite frankly? I can just anecdotally look at just how many candles have a range of almost 2 points, and I can go back and just say, okay, a 2-point range is probably on a little bit larger than the average. So I know that this is an abnormal range. It's beyond the sort of historical volatility that we've observed. In that case, yes, I would love to wait for an inside day. That would be today. I would love to look for a minor low. That would have to form today, and then you've got it, James. I could look for a setup tomorrow. Now, a lot of traders say, well, what if we just snap back tomorrow? What if the movement just goes higher and I don't get that lower low or get that inside day minor low pattern setup? Well, we're sitting here at the 55 propulsion. And I can't say that the 55 has been in any significant way in play, but I know that the 55 could hold. I know that we have a double green environment. There's a lot to like. As long as you are okay with the market possibly heading a bit lower, and by a bit lower, I'm thinking 2470, maybe something along the lines of 2420, as long as you've sort of calibrated your entry to accept that a lower low might come today, throughout the session, you can go ahead and take an aggro sized position. Aggro, why do I nickname my entries? To remind me about position sizing and risk. And so, yeah, James, we can talk about this particular symbol when I see you all for the live trading, our weekly live trading Q&A in the mastery room in 14 minutes. So bring it up. I'm happy to break it down there. All right. But yeah, I mean, usually I'm going to tell you, look, it's a red grab candle. Yes, we're testing the mean of the V-score. Gotta like that because we have been able to stay above the V-score since the end of August. So I think my more conservative approach would be red grab candle in a double green is really not a trend break, but it does get us wondering about volatility and sort of the chaos sometimes that can ensue, and a better way to sort of manage or at least have a way to measure if the chaos is slowing. That's that minor day, minor low, or inside day. All right. Thank you for the question. And you got it, James. You got it. You got this stuff down. Kevin, hey there. Good morning. What is my opinion on D-Dog? Sure. All right. Let's jump into D-Dog. And again, start with structure. Structure clearly tells us what? When I take a look at the structure of this market, I'm gonna look to the very bottom of this chart, and I'll see that it's a double green. And if it's double green, that tells me that pullbacks like this into the wave, very similar to what we saw in September. You take a look at that September 13 move to the downside in the wave. I'm fine with that. I think it's a good pullback. We're actually at a volume ledge area as well. Let me show you on the trading view charts. I'm at a sort of moderate volume ledge as well, right there, 135.50. So I do like the way this one looks. I do like the setup it's presenting, and it's a blue candle inside the wave. Yeah, I like it a lot. I don't have a problem with it. Double green. There's not a whole heck of a lot that I don't like. We don't have earnings breathing down our neck. We have until November 16. And the only other thing that I would say is, look at D-Dog within the context of other stocks that would be considered in the pond that D-Dog is in, and be aware of what might be generally happening with that overall group. I remember on Monday, or was it Friday, I sent out a number of stocks that were relative outperformers in choppy to somewhat bearish corners of the market. All of them, there was 5 names, succumbed to the outgoing tide. We need to remember that. And so when I look at D-Dog, I think the IPO ETF, that's about the only one coming to mind, would be something I'd look at, but that's not really a grouping that would be particular to D-Dog. It'd be a grouping particular to IPOs. So yeah, you have the possibility here, Kevin, of a relative outperformer in D-Dog. So I would definitely keep an eye on it. Nice setup, and sort of uncorrelated relative outperformers. What does that allow us to identify? Uncorrelated, meaning they're not particularly attached to a broader narrative, and the relative outperformance. That to me is the making of a very good, as we like to call it, this is a Johnism, a honey badger, right? And so while say Tesla is a relative outperformer within the Nas, I'll typically not give it that particular moniker because it's still attached to the Qs. But if I can find something that's relatively unattached, it's something that really isn't going to be under pressure when an ETF, a particular niche, is moving higher or lower because its weighting just isn't significant in a high volume ETF. That's actually a really great place to be right now, specifically. Now, uncorrelated is not always something that I want to focus on. Most of the time, especially when we have broader clarity, up or down, but typically up, clarity in the indices and sectors, I like the correlation. It's a great secondary confirmation of structure. But in an environment where the broader averages have gone choppy, some of these uncorrelated names are likely going to be really, really good names to have on a list for us. All right, great stuff. Thank you, Kevin, for that question. All right, next is, hang on, I'm just scrolling down the list here. Good morning, good morning. Great to see everybody. Christian asks, what do I think the QQQ and IWM will go next? Okay, so anyone who doesn't tell you, I have no stinking idea, is just pulling your leg. I don't know. I can only look at probability and structure, right? I completely appreciate the question you're asking, though. So let's start with structure. Let's kind of go step by step through the way that I'll look at what is probable according to my tools. So let's always assume this, because anything less than this is really deluding ourselves. Let's presume we don't know what a market's going to do. But let's also presume we want levels that we've pre-identified on the chart that, if reached, we know what we want to do when they get there. I don't know what the market is going to do, but I do know what I want to do if the market gets to certain price levels. It's a very different approach to trading, to any kind of market analysis, just accepting that no one knows, and structure is going to help us better understand what we want to do at support and resistance. So structure here on QQQ, we're in a non-trending market. And I would even take a step back, and I would not do this analysis on QQQ. I would do this analysis on the NASDAQ. So we start off with looking at the NASDAQ, and it's also in chop. I can say, all right, if it's in chop, I'm no longer buying the dips. One of the things that happens to dip buyers, and we're definitely, I'm a dip buyer. I consider myself a buyer of dips, but we're sometimes, and by the way, I'm a seller of rips, whether it's dips or if it's rips. That's trend following jargon right there. So the dips get sort of the meme treatment. They get mocked, if you will, because dips are valid in trends. When the markets are no longer trending, there should be no discussion of dip buying. Whatever market you're looking at is no longer in a trend, there's no discussion of dip buying. It's not even a valid paradigm for the markets in its current state. And with that, we have to shift our jargon, yes, but really we're shifting our tools and expectations. So after red grab candle, yellow JT trend, 2 red grab candles, still a yellow JT trend, this market is in distribution. Straight from Charles Dow 101. This is now in distribution. In distribution, the jargon flips away from dips to oversold buys. Now, why would I say oversold buys? Well, we want to respect the trend that was, right? So we just take a look. Oh, how do we behave before the sideways action started? Well, we were heading up. And this idea that markets are either heading up or they're heading down is just frankly wrong. We know this from observation. We know this from folks like Charles Dow and Richard Wyckoff and people who have, built a lot of their processes from Charles Dow's work. And that is, there are 4 market stages. And if there's anything that you ever get from a moment of here in Charts and Coffee or any time that you spend with me, it's to know this. There are uptrends and there are downtrends, but there is an accumulation market trend and there's a distribution market trend. So we have two types of trending markets. We have two types of non-trending markets. And what hurts a lot of traders is the assumption that a broken uptrend is a downtrend. It's a wrong assumption. It's an assumption that then just says that every broken uptrend is a V top or a very acute U top. And that just isn't the case. What we typically see are things more along the lines of W's or M's, or even sort of variations of that, like a Dow 1, 2, 3, where we have uneven peaks as opposed to more even peaks. Okay. So with that being said, in terms of where it's going to go next, if I can identify a level using volume, using an indicator like a ready aim fire or a slow stochastic, I love to combine slow stochastic and my V-score. I love to combine ready aim fire and my V-score, and I'll try to find an exhaustion level. And that's what we're talking about. Where is there an exhaustion trade? I know I kind of deep dove this, but gosh, if there's anything that I can communicate that would absolutely move the needle throughout your career, it's that little diatribe that I just, I'll step off the soapbox now, but please, if you can get to a point where, you're looking, however you're measuring it, doesn't have to be through my secret squiggles, my indicators, but however you are measuring trending versus non-trending markets and historical volatility to identify, say, accumulation versus distribution, however it is you do it, please make that the bedrock of your process. So I would have to say, once we reach a oversold level, I'm looking for a move up to about the halfway mark of this choppy range. I'm not looking for the market to go right to the top and make new highs. Oh gosh, no. In fact, distribution actually lowers the probability that we're going to see follow through if and when we make a new high. So this is really more like, what's the halfway mark? That's probably going to be a pit stop. And if we get to the upper end of the range, we're probably flirting with overbought. So from oversold to overbought. And then your question about IWM or RTY really drives this home beautifully. So I love the combination of the two symbols, in the same question, because RTY, IWM has been doing this all year long. What do I mean by that? Thank you very much, Darvis, for the resistance recognition. We automate this process. Thank you very much for the support. Cool. Look at where we've just been moving through. That's distribution. The width of the range is what makes it distribution. So when I get down to the lows, yes, it's support. It's not a dip though, right? Because look how long we've been really yellow. That's not a dip. It's actually an oversold level. Again, slow stochastic, ready aim fire. However you want to measure this, to me, as long as I can maintain support around a -1 standard deviation, around, not necessarily at, but around a -1 standard deviation of the V-score, I'm right as rain. As long as we can maintain support around the Darvis low and this 200 propulsion, right? Moving like this, that's a buy. That lower end of the range is a buy. And why would I prioritize the buy? Because the trend that preceded the chop was up. Not that there aren't shorts. I mean, clearly the resistance level has been holding prices lower, but I tend to want to focus on the long side because we are still above the 200. We are still above the -1 standard deviation of the V-score, and the trend that preceded the chop was up. So the directional bias and the higher probability side of this market for me is still to the long side. So again, don't know where the markets are going to go. Nobody does, but all we can say is this something we've seen before? And what's the probability of it moving in a certain way? And that's what I hope most traders, the type of tools that you decide to use, I hope that's the kind of question, those are the kind of questions you're asking, and that your tools are able to answer those questions. Because at the end of the day, your indicators really have to answer a specific type of question. Is there volume here? Is there exhaustion here? Is there momentum here? What type of environment are we in? And if you can answer those consistently, you're in good shape, right? You're in good shape. Last question before we jump into the mastery room. As a day trader, do I approach today with caution? I have to, but Jamie, it's not quite going to be, hopefully, as difficult as yesterday, because rather than Kapow at 10 a.m., we've got Kapow at, what is it, 11:45? Yeah, 11:45, right? So won't be necessarily as bad, but it's still going to be tricky because we know as we approach the end of the morning session, we've got Powell waiting. And that's always going to be something that traders are going to be concerned about pre-positioning in front of, and it could create unusual or maybe even a little bit more intense profit taking or exiting of positions as we go into the European close. Okay. As always, thanks for being here for Charts and Coffee. See you all tomorrow, same time, same station. I'm going to be heading into the mastery in just a moment. I'll see you all there. And if you haven't already, we have a webinar coming up. It's coming up right around the bend here. Next Wednesday? Looking at my calendar. Yeah, next Wednesday. We've got our kind of talking about a lot of the concepts I'm sharing with you now. We've got our webinar coming up, simplertrading.com/trend, Wednesday, October 6th, 8 p.m. Eastern. All right. Hope to see you there. Definitely give me a shout out if you're there from the Charts and Coffee crew. All right, gang. I'll talk with you soon. Hey traders, Raghee here. Let's get a quick audio and video check in for our weekly live trading and Q&A. Great to see everybody. Happy Wednesday, everyone. All right. So Jesse asks, why must Powell speak so much? That's a really good question. Jesse, I think he's trying to save his job. A lot of folks are finding out that, oh my gosh, yes, Federal Reserve members trade based on the information they have. Sacre bleu.